Hello and welcome to the New Indian Express. The RBI seems to be taking the neutral approach despite the economic growth hard landing in the second quarter of this year. Governor Shaktikanta Das sort of vowed to protect peace with blood, reminding everyone that the central bank's price stability mandate and its commitment to the flexible inflation target comes before everything else. In other words, growth must stand on its own given the threat of inflation, particularly food prices which continue to run like a frightened horse. The six-member Monetary Policy Committee voted to keep the repo rate unchanged at 6.5% for the 11th straight meeting. The repo rate is the interest rate at which the Reserve Bank of India loans money to commercial banks. A major declaration by Mr. Das was that the central bank slashed real GDP growth forecast to a soul-crushing 6.6% from 7.2% for financial year 2025 and raised inflation forecast upward to 4.8%. After the second quarter shocker where growth slowed down to a low of 5.4%, there was strong expectation of 25-point repo rate reduction. But Governor Das is placing all his bets on current and next quarter of a growth upside. If not a repo rate cut, markets anticipated quantitative liquidity boosting measures, and in line with expectations, RBI announced a 50-point cut in cash reserve ratio, indicating that it's the best kind of nourishing that it can offer for the economy. The cash reserve ratio is the proportion of the deposits banks set aside as cash, and Friday's move is expected to infuse Rs 1.16 lakh crore liquidity to the banking system, facilitating bank lending and also lower market interests. According to Das, the sharper than expected slowdown in the second quarter of the current fiscal was led largely by a deceleration of industrial growth, which in turn was affected by subdued manufacturing, contraction in mining and lower electricity demand. The calls for cuts have come from none other than Finance Minister Nirmala Sitharaman and Commerce Minister Piyush Goyal, while analysts reason that the February may be too late to cut and could force the central bank to compensate with larger than expected cut at its next meeting. But the central bank insists that the worst is over, and high-frequency indicators confirm that the growth slowdown bottomed down in the second quarter. Let's all hope that the RBI has placed its bets on the right horse.